If you look at what they're doing right now, there are things pointing to massive gold acquisition just since November that maybe is a stopgap for that. Now, look, there's a fine line between conspiracy and reality, Jeremy, and I think we're treading that line. But just since November, since we have become net importers of gold rather than net exporters, the United States has brought in over 12.5 million ounces of gold and over 45 million ounces of silver from the London vaults into the U.S. vaults. Yeah. JP Morgan is set to deliver $4 billion with a B of gold into the COMEX for the February contract. And Blythe Masters, who used to run the trading desk for JP, you can Google it, it'll pop right up. She said long ago, JP Morgan does not buy gold for themselves, it's for customers. Now I ask you, what customers got $4 billion in their back pocket to buy gold with? Let that one sink in for a minute. And there are many other things related to JP Morgan. I might add just one more. They paid a $920 million fine for manipulating the metals market. And it always chafed my rear end that they were allowed to continue to be allowed to be the custodian of the world's largest silver trust, SLV. I mean, that just didn't make any sense to me. They paid $920 million fine, the largest fine ever handed out by the Justice Department at that point. And yet their trading desk made $1 billion that year. Slap on the wrist, you walk away 80 million up, and you still get control of the ETFs. HSBC Bank always controlled GLD, but guess what just happened recently? Oh, that's right. JP Morgan now controls GLD. So you have BlackRock and JP Morgan holding SLV and GLD. And when people have asked me over the years, do you think gold will be confiscated? I said, no, I don't. I think if they wanted to take the gold, if they wanted to have the lion's share of it, all they would need to do is say, let's take the ETFs. Now, nobody except the insiders can pull gold out of the ETFs. And I'll mention about that when I'm done. I know I'm kind of going a little further ahead of script here, but it's important. And the insiders are the only ones that can take metal out of the ETFs. You and I can't. So if indeed they were to close those two accounts, be sitting on this massive stockpile of gold, where right now in the two vaults that JP Morgan owns, one in London, one in New York, they possess more gold than over half of the dang G20 countries because of this custodianship. They could close those programs, look the world in the face and say, what? We didn't break any laws or infringe any civil liberties. We have the right to do this. We're closing the fund. The money that people had invested in gold is now in their money market accounts Monday morning. They're free to go buy physical gold and silver. It would give them the ability to have their cake and eat it too. Now, am I extrapolating? Yes. Do I know that this would happen? No, but it's a little bit uncanny. And along those same lines, since gold has been on this wild tear, right? It's a little weird that 16 tons have come out of GLD just recently, fallen out. In other words, the conventional wisdom is, well, it's a strong dollar, it's high interest rates, it's profit taking. I call BS again.
In recent months, the global financial landscape has been marked by unprecedented movements in the gold and silver markets, highlighting the enduring value of these precious metals as safe haven assets. Since November 2024, the United States has transitioned from a net exporter to a net importer of gold, bringing in over 12 million ounces of gold and 45 million ounces of silver from London's vaults to U.S. repositories. This substantial influx underscores a strategic shift in the U.S. approach to precious metal reserves, reflecting heightened economic uncertainties and potential policy changes. A pivotal development in this context is JP Morgan Chase & Co.'s plan to deliver gold bullion valued at over $4 billion against futures contracts in New York. This move, involving approximately 30 million troy ounces of gold, aligns with President Donald Trump's proposed tariffs on imports from key trading partners, including Canada, Mexico, China, and the European Union. The anticipation of these tariffs has prompted financial institutions to relocate significant gold quantities to U.S. soil, aiming to mitigate potential trade disruptions and capitalize on favorable pricing differentials between London and New York. The logistical challenges of transporting such vast amounts of gold are considerable. The process involves recasting larger 400 troy-ounce London good delivery bars into smaller 1 kilogram bars preferred in the U.S. market, necessitating around-the-clock operations at Swiss refineries. This surge in demand has led to bottlenecks at key vaults, including the Bank of England's facilities, and has driven up short-term lease rates for gold. These logistical complexities highlight the intricate nature of the global gold trade and the lengths to which institutions will go to secure and reposition their assets in response to geopolitical and economic shifts. Beyond the physical movement of gold, there is a notable trend of central banks and sovereign wealth funds increasing their gold holdings. This strategy aims to diversify reserves and reduce reliance on U.S. treasuries, especially amid geopolitical uncertainties and the threat of sanctions. Countries such as China, India, and Turkey have been among the largest purchasers, reflecting a global move toward sanctions-proofing national reserves. This trend underscores the perception of gold as a stable and reliable store of value in times of economic volatility. The recent surge in gold prices, which have surpassed $3,000 per ounce, has further fueled interest in the metal as a hedge against inflation and currency devaluation. Major financial institutions, including J.P. Morgan, have revised their gold price forecasts upward, anticipating continued strength in the market. This bullish outlook is supported by ongoing geopolitical tensions, a weakening U.S. dollar, and robust demand from both institutional and retail investors. In parallel, the silver market has experienced significant activity. The outflow of silver from London to the U.S. has been substantial, with holdings falling to their lowest levels since mid-2016. This movement is partly driven by silver's critical role in industrial applications, such as solar energy and electronics, coupled with its appeal as a precious metal investment. The current gold-to-silver ratio suggests that silver remains undervalued relative to gold, indicating potential for price appreciation. The strategic maneuvers by major financial institutions, such as J.P. Morgan's significant gold deliveries, and the broader trend of central banks increasing their gold reserves, highlight the enduring importance of gold and silver in the global financial system. These developments reflect a growing recognition of the need to hedge against economic uncertainties and potential currency fluctuations. As the geopolitical landscape continues to evolve, the role of precious metals as foundational assets in national and institutional portfolios is likely to become increasingly prominent. For individual investors, these trends underscore the potential benefits of including gold and silver in diversified investment strategies. The physical ownership of these metals offers a hedge against inflation, currency devaluation, and geopolitical risks. As always, investors should conduct thorough research and consider their risk tolerance when making investment decisions. In conclusion, the recent movements in the gold and silver markets reflect a broader shift toward asset diversification and risk mitigation in uncertain economic times. The actions of major financial institutions and central banks serve as a testament to the enduring value of these precious metals. As the global financial landscape continues to change, gold and silver are likely to remain integral components of investment portfolios worldwide.
It's the insiders redeeming their shares for the physical metal and pulling it out to have strategic control of it before whatever happens. So you put it all together, a tier 1 asset, the massive repatriation, net importers, $4 billion from J.P. Morgan, 12, all of these millions of ounces pouring in of gold into the New York COMEX market. All of this stuff happening, JP controlling GLD and SLV, under the guise of tariffs. Now, he's not going to tariff silver. He won't. It's a structural deficit. It'll blow up our industry. Is he going to tariff gold? Or is he just saying that to get it all home quietly under the guise of potential tariffs, playing this spread between London and New York profit? Or is it something much bigger? Is it what Scott Bessent is talking about, to monetize the balance sheet? Is it what Judy Shelton is talking about, to issue treasuries collared to gold? Well, if the gold isn't there, how do you get it? Oh, I know. Here it is. And so I would simply say everything inside of me is screaming.
Yeah.
This is a whole hell of a lot bigger than just Trump tariffs. No, I think it's way deeper than that, Jeremy. I think there's something in store for gold, which is what? The only other tier 1 reserve asset in the world that all the central banks are buying hand over fist. It would benefit them all of the central banks. And maybe that's what the plan has been all along, not sure. But why else would the most powerful bank on the planet, the most powerful, the BIS, reclassify gold as the world's only other tier 1? I'll let your listeners think about that and decide for themselves. For me, there's a plan in motion that the insiders, the central banks, have known about for a long time.
Yeah.
We're just finding out as it progresses. And you could, for the last several years, that it's been China and the BRICS nations who have certainly gotten out to a massive head start. And maybe that's why you're seeing such enormous amounts. I mean, Trump doesn't do anything small now, does he? And maybe that's why you're seeing such an enormous race since November. I mean, if they took a look and said, do you understand what Trump was talking about, the BRICS and losing the world reserve status on his campaign trail, and said this would be worse than any lost war? He's right. And he saw what they were doing. And maybe that's why he brought in Scott Bessent, whose largest holding is gold. And maybe that's why since November, not since he took office, but since November, the insiders were alerted and start repatriating their gold. I mean, we have a long way to catch up. But I would argue that in my mind, look, the Chinese are the largest producers of gold in the world. Pretty dang close to the largest producers of silver also. It's arguable our first or second. They're net importers of both. They hardly sell an ounce ever. They became net importers of silver recently. They were net exporters. They're flying the world buying doré and concentrate. They're buying up with their Belt Road Initiative. All of the countries that they're associating with are massively resource rich and underdeveloped. So they help them build roads and bridges and maritime channels and railroads and gold and silver mines and refineries for a piece of it, and industrialize their countries and bring those resources to the market. They get a piece of it. They understand. You see, the difference is the Chinese think in terms of decades, we think in terms of days, and that's a problem. They have been very methodical in their accumulation and in their production, and you know, their numbers stood at 1,200 tons half of my career.
The past several months have revealed a dramatic shift in how global financial institutions, central banks, and high net worth individuals are approaching gold and silver. This is no longer just about traditional investment trends or hedging against inflation. It is about a fundamental restructuring of the global monetary system. The sheer scale of gold and silver repatriation, JP Morgan's unprecedented deliveries, and the increasing role of bullion in global trade all indicate that we are moving toward a major financial transformation. While Part 1 covered the movements of physical gold and silver and their economic implications, this part will explore why these moves are happening, what they mean for the future of currency and global trade, and why individual investors need to pay close attention before it's too late. It's no coincidence that since late 2024, the U.S. has flipped from being a net exporter of gold to a net importer, bringing in over 12 million ounces of gold and 45 million ounces of silver. At the same time, central banks worldwide are accumulating gold at record levels, shifting away from U.S. treasuries. While some analysts claim this is merely a response to inflation or geopolitical uncertainty, the scale of this movement suggests something much larger at play. The most logical explanation? A transition away from the current fiat currency system and a return to asset-backed monetary policies. Nations like China, Russia, and India have been increasing their gold reserves for years while reducing their dependence on the US dollar. The BRICS coalition, which continues to expand, has already announced plans for a gold-backed settlement system, allowing trade between member nations without reliance on Western banking institutions. If this trend continues, it could eventually undermine the dollar's global reserve status, forcing the United States to respond with its own gold-backed financial instruments. This is where the theory of gold revaluation as a tool for debt reduction and financial restructuring comes into play. If the U.S. Treasury were to reprice gold at a significantly higher level, it could allow the government to pay down portions of the national debt while restoring confidence in the dollar. Analysts like Jim Rickards and Alasdair MacLeod have suggested that a potential gold revaluation could see prices move to $10,000, $24,000, or even higher to facilitate a financial reset. JP Morgan's recent $4 billion gold delivery to COMEX, combined with their control over the largest gold and silver ETFs, GLD and SLV, suggests that the financial elite are preparing for this shift before the general public catches on. Historically, whenever governments and central banks make major moves in the gold market, they do so quietly and well in advance of official policy changes. Those who recognize this pattern have the opportunity to position themselves ahead of the curve, just as central banks are doing now. While gold has taken the spotlight in these discussions, silver is playing an equally critical role, one that many investors have overlooked. Unlike gold, which is primarily held by central banks and sovereign wealth funds, silver is heavily consumed in industrial applications. With growing demand from the solar, electronics, and electric vehicle (EV) industries, silver supply is shrinking at an alarming rate. For the past 7 years, silver has been in a structural supply deficit, meaning that more silver is being used than is being mined. The Silver Institute recently reported that global silver demand is outpacing production, with investment demand rising sharply as institutions begin to recognize silver's monetary potential. Yet despite this, silver remains historically undervalued compared to gold. The gold-to-silver ratio currently sits around 90-1, far above its historical average of 50-1 or lower. If silver were to return to its traditional ratio, its price would need to more than double from current levels. Beyond price dynamics, silver offers an advantage that gold does not. It is far less likely to be subject to government confiscation or excessive taxation. Throughout history, during times of financial crisis, governments have sought to control gold ownership. In 1933, the U.S. government enacted Executive Order 6102, which forced citizens to turn in their gold holdings under penalty of law. While such extreme measures may not be as likely today, it is possible that new restrictions, taxes, or reporting requirements could be introduced for gold holders. Silver, on the other hand, has not historically been targeted in the same way, making it a stealth asset for those seeking monetary protection without government interference. There has been speculation that President Trump's proposed tariffs on imported gold may be a cover story for strategic gold repatriation. If tariffs were introduced, they would make it more expensive to import gold into the U.S., potentially driving up domestic prices while discouraging foreign competition. However, some analysts believe that this is simply a tactic to bring as much gold back into U.S. vaults as possible before an official monetary shift occurs. Under the guise of these tariffs, we have seen an unprecedented amount of gold flow from London to New York, with J.P. Morgan and other major institutions leading the charge. The question is, why now? One theory is that the U.S. government and financial elites are quietly repositioning gold reserves in preparation for a new gold-backed financial system. If this is true, then the average investor has a limited window of opportunity to accumulate gold and silver at current prices before a major revaluation occurs. With all of these rapid changes in the financial landscape, the question remains, how can individual investors protect themselves and capitalize on these trends? The answer is clear. Own physical gold and silver before the market fully recognizes their importance. Unlike paper assets, physical bullion is free from counterparty risk and cannot be printed out of thin air. Given the potential for government intervention, market manipulation, and supply shortages, investors should consider diversifying their holdings outside of traditional banking institutions. Holding gold and silver in secure private vaults, both domestically and internationally, can provide an added layer of protection in case of sudden regulatory changes. The financial elites and central banks are not waiting for an official announcement to prepare. They are already making their moves. Gold and silver prices are not simply rising. Fiat currencies are declining in value, and this trend is only accelerating. If gold revaluation occurs, those who own physical metal will see their purchasing power soar, while those who rely on paper assets will be left scrambling to catch up. The biggest financial shifts in history have always been preceded by quiet moves from insiders before the general public catches on. Right now, all the signs are pointing to a massive restructuring of the global monetary system, and those who fail to prepare will pay the price. The time to act is now, before gold and silver enter a once-in-a-generation repricing event that will reshape the world's financial system for decades to come.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.